Hey, what's going on, guys? It's Sean McKay, aka The Lousy Investor. And today we're going to look at some things that I do that are very different and very atypical from many real estate investors out there, especially smaller kind of mom and pop investors. I'm not talking about the big institutional investors, but those of you that are out there listening, either looking to get into real estate or maybe you own a handful of properties. And maybe something will resonate, maybe think twice about doing something that you're currently doing. So the first thing I want to talk about is cash reserves. And for me, this is something that is really perplexing to me when I think about the common practices out there in the real estate community. So when people think about cash reserves, so many times I hear people say, well, I'm going to have this property rented soon. It's going to be producing income. It's okay that I'm spending pretty much all of my money to repair the property. I think that's a really dangerous way to think about our real estate portfolio. To me, the most important thing is making sure that we're going to be able to keep this asset long term, that we're going to be able to service all the responsibilities. So it could be the smaller ones like taxes and insurance, but for most of us, it's going to be the bigger ones like the mortgage payments. And one of the big takeaways from all the craziness that happened in 2020 was that we just don't know what's around the corner. What if there's another wave of COVID? What if there's some other circumstance that we're not prepared for? And if we don't have cash reserves, and if our tenants are unable or unwilling to pay rent, that can put us in a really bad position. So one thing that I've come to really appreciate in the way we've structured our portfolio is having a lot of cash around, even if it means we're not buying as many properties as we possibly could. Making sure we're safe and conservative with our portfolio is really critical. And so what my wife and I have decided to do is to make sure that we maintain at least a $10,000 cash balance for every unit that we own. So if we own 20 rental properties, that's $200,000 in cash sitting in the bank, in addition to our personal fund that we have for emergencies. So if I lose my job or if something happens, we have an emergency fund, but we also have emergency funds, if you will, for the rental properties. Now, ideally, we don't have to dip into that because, again, as we like to think, the rental income will always take care of that property, but it's just something to consider. All right, so the next thing I want to talk about is what I think of as the unsexy neighborhoods or the unsexy areas. So regardless of where you live, there's good areas, there's bad areas, there's areas that are up and coming where you're starting to see the new builds coming in, you're getting to see properties getting completely refurbished and made much better than they were before. And that's great, and you can certainly see a pop of appreciation. But what I've noticed over the years is that as a neighborhood is really starting to turn the corner and there's lots of investors coming in, we have kind of this lemmings effect where everyone's going to that neighborhood. You're only looking for fix and flip properties in that neighborhood. You're only looking for rental properties where all the investors are going. And I understand it. It's human nature. You want to feel like you're doing what is accepted, what seems to be the popular thing to do. The problem with that is that that drives up the price points so much so quickly that you end up buying properties that don't cash flow, that don't have any equity, and at some point the neighborhood kind of stabilizes and you're not seeing this huge appreciation in that specific neighborhood. So you should be really, really careful with that. Now, part of the reason why we named this channel The Lousy Investor is because, frankly, most of the properties over the years that my wife and I have purchased have not really been considered interesting or sexy deals when we've done them. It's kind of either a no-name neighborhood, it's maybe just a neighborhood or two further outside the city than the cooler, the areas where all the investors are going. But that gives us the advantage of not having nearly as much competition. And so that interesting neighborhood for rental properties, they might be selling for, let's say, $250,000 for a 3-bedroom, 1-bath, 1,000 square foot brick house. But in the neighborhoods that we choose to invest in that aren't as interesting to the investment community, that same rental property, the 3-bedroom, 1-bath brick house that's 1,000 square feet, we might be able to buy for $160,000 or $170,000 because it doesn't have that name yet. So as the area overall continues to improve, we get to kind of go along for that ride of appreciation, and we've been really fortunate, and that's worked out really well for us. So that's something to keep in mind. So we'll call that the unsexy area. So the next thing I want to focus on, and you kind of see a theme here, I'm a very conservative investor. I grew up in Florida, my first deals were down there, and I understand kind of how badly things can go in a real estate market cycle. And so I've learned a lot of lessons over the years. And so the next thing I want to talk about is thinking about and preparing for worst case scenarios. I think that as investors, whether it's picking individual stocks or it's investing in real estate, a lot of us tend to be very optimistic about the future for that asset. We think the neighborhood's going to continue to get better. We think that there's going to be massive appreciation, and many times that can happen, but there's also times where asset classes will have a pullback and values will come back. And so if we're not prepared for that financially and frankly emotionally, that can be really difficult and challenging for us to deal with. And so I think that when we look at properties, we're always assuming, my wife and I, that the rents will not continue to go up, that the property 10 years from now will actually be worth what it is today. So we're buying it based on what it is today, and maybe even assuming that rents come down a little bit, does the property still cover itself? So I think that, again, I'm not trying to be negative, it's just a way of preparing so that if by some chance things do go south, that we're a little bit better prepared to handle those things, such as we mentioned earlier, the cash reserves, things like that. So we'll call that the worst case scenario. All right. So the next thing I want to talk about is, for those of you especially that have full-time day jobs, so you're out there, you're working for some company, W-2, 1099, maybe you have a wife, kids, social life, whatever it may be, many people are extremely busy. And so when you try to add something to your plate, when you want to get into the investing game, that is a big project. There's so much to learn, there's relationships to create, you have to learn about the real estate market or the stock market, whatever you're investing in. And so there's a lot of work that goes into that. And so my wife and I have always been a big proponent of being excruciatingly focused in what we're looking for. And so I'll give you an example of what that looks like. So we'll call this very focused. So when I go to real estate meetings, a lot of times we get to introduce ourselves at the beginning. We're talking about what we've done or what we're looking for so that people can kind of identify us. So it could be, hi, I'm Jeff, I flip houses. Hi, I'm Jessica, I'm a wholesaler. You know, there's some general kind of tag that we tend to give ourselves as real estate investors. And usually they'll say something like, I'm looking for a deal. And that's completely fair. Everyone wants a deal. Everyone wants to feel as though they can find an interesting investment opportunity. But what I noticed over the years at these meetings is that everyone's looking for a deal. And so if somebody comes across a deal, then there's not really anything differentiating between Jeff and Jessica and DeAndre and whoever else is there. Everyone's kind of in that same sea of, I'd like to buy an investment. So what we did was we took a very specific criteria for what we were looking for, so that when people found that opportunity, let's say wholesalers that were out there looking for buyers for properties that they have under contract, wholesalers could think of us because we were very, almost comically specific as to what we were actually looking for. So an example of that would be, each year, or sometimes for multiple years, my wife and I would say, okay, the goal this year is to buy something very specific. So that could be, okay, we're going to identify, let's say 2 or 3 neighborhoods, but I'll just pick out one neighborhood and I'll say, Windsor Park is going to be the neighborhood that we're going to invest in, and we are looking for a property in Windsor Park that is a 3-bedroom, 1-bath, brick house. And we want to buy it and rehab it and be into it for, the market has changed drastically, but let's say at this point in time, it was under 150K. And so we would go to meetings and we would say, this is exactly what we're looking for. So obviously that's really granular and really specific, but if someone came across this type of property, there's at least a better chance that they might give that to us first and say, boy, we really know that Sean and Heather like this type of property, so we'll give them a chance and see if it's something that they're able to close on. In fact, we were so consistent with our message that a friend of mine in town, he would call us the three little, or he called me, frankly, one of the 3 little pigs, because as you know from that story, if you have kids, the 3 little pigs, they have different types of houses, and I was always looking for brick products. So whether it's duplexes or houses or whatever the case may be, just like the 3rd little pig. So I actually played that up. I would say, hey, think of me as the little pig. I'm the 3rd little pig. I like brick products. So if you have that older brick house or duplex or triplex, whatever we were looking for at that time, please think of me. So it allowed us, with our very small sliver of time and energy that we were willing to devote to real estate, to be able to kind of put ourselves out there as a very specific type of buyer. So again, for those of you that are really busy, that could be extremely helpful as you're thinking about how to buy your first or your next property, especially in a really competitive market. So the next one I want to focus on, and this is something that's debated on every investment platform out there, especially for real estate investors, and that's the idea of paying off good debt. And so the general rule of thumb for real estate investors is that the best type of debt you could possibly have is 30-year fixed conventional debt. And so what that means is it's a government product. You put your down payment, sometimes a 10 or 15 or 20% as a down payment, and then you never have to refinance that debt. There's no callable period of time where after 5 or 10 years you have to refinance. It's not an adjustable rate. Whatever your interest rate is, so it could be a 4% loan, it will be a 4% loan for the next 30 years. And so as real estate investors, that's kind of the holy grail of debt. That's something that everyone wants to kind of load up in their portfolio, especially as we've been in such a low interest environment. And so the idea of paying off that type of loan product is really almost sacrilegious in the real estate investing space. But my wife and I, we've thought about our portfolio, we've thought about what we want our financial life to be, and it for us, it feels like psychologically, even if it is a small mortgage on a property and we have significant equity and we have significant cash flow, it still never feels like it's a valuable asset to us or one that produces as much cash flow if there's still that debt on the property. It's, for me, kind of a psychological hurdle. And so we sat down over the last year or so and we decided the thing that will make us feel better about our portfolio is if we pay off the remaining mortgages that we have on those properties, so that again, if there's some sort of moratorium on rent and tenants are unable to pay rent, we're not going to be as concerned, because at that point in time, we're going to have pretty minimal expenses we're responsible for, such as taxes, insurance, things like that. And so that allows us to not only really kind of bulletproof our rental portfolio, but it also allows us, if we ever decide to kind of scale up our portfolio of rentals again, it makes us feel as though taking on an extra $100,000 or $200,000 in debt is not as big of a deal because we have such a low baseline of debt. So for us, it's kind of a multi-tiered kind of benefit, if you will, to paying off that good debt. So again, I understand it's not going to be for everybody to pay off a 4% loan, but for us, being able to bank that extra $400 a month or $800 a month, whatever that mortgage payment is, that's pretty interesting to us and helps us as we're kind of in this phase of our investing where we want to be passive, we don't want to have as much stress and things of that nature. So We're all going to be on our own course. Again, I understand that many of these things you're not necessarily going to agree with, and so that's okay. We all have our own path and where we want to go with this. I just want to share a few ideas of some things that have helped us to frankly sleep a little bit better over the years and just kind of make our portfolio what makes sense for us. And so maybe this will, if nothing else, encourage you to think about your own criteria and what you want your investments to look like. So if you found this valuable, please give a like, a comment, and if you haven't already, please subscribe to the channel, and we'll see you soon. Thanks so much.